I just had a long discussion with a crypto tax advisor and we gotta talk.
They look paced and they tell me, Chris, we've been trying to do this ourselves for 3-4 months. Hard sometimes, and it's just so complex. The IRS is becoming very aggressive because it's not a question of if you will be caught, you will be caught. It's a question of when. And what better time to become proactive in a bull market, because at least you have some funds. A lot you can do to optimize your crypto taxes by staying where you are. So
we've got to get very real here. I asked you on my X profile whether you have ever paid tax on crypto, and over 70% of you said no. And that is a problem. So in this video, I'm gonna give you everything you need to know about crypto taxes. We'll talk about what to do if you have not paid taxes ever, how you can optimize your taxes with some simple techniques, how you can write off rogues, scams, hacks, and coins and NFTs that just simply went to zero, how to handle taxes when it comes to investing, trading on centralized exchanges, decentralized exchanges, NFTs, liquidity pools, staking, mining, and every tip I'm gonna give you will be applicable regardless of your location. There are a billion ways to make money in crypto, and I am on a mission to find them all. My name is 𝗕𝗏𝗘. I share everything with you, so if I make money, you can make money too. If you're new to the channel, subscribe. We bring you the best offer in the crypto industry. If you're returning, smash the like button and let me know in the comment section if you like this content and what you want me to review or test next. So one way to make money in crypto is to not pay that much taxes and preserve all your capital or your gains. And very important, before we get going with this video, I have to tell you I am not a financial or tax advisor. Anything in this video is not financial advice, and you should always consult with your local tax advisors or authorities. But this is a very sensitive topic, so I couldn't just go on Google and share with you whatever I found. I had to take another approach, and this is exactly what I did. So I reached out to Chris Herbst from 𝗏𝗏𝗘𝗏𝗏, who is specialized in crypto taxation, and he told me that there are a lot of things that you can do to optimize and minimize or even completely eliminate your taxes without having to move to another country. My idea to minimize my crypto taxes was, okay, I'm gonna move to Dubai and that's it. Well, it's not that easy. For example, if you're in the United States, you can't just simply relocate and solve your taxation issues. Also, if you have not paid your taxes up to today, it doesn't matter what you do in the future, because the past years that you have not paid your taxes for will be taxed on the location where you are right now. I got good news, because I got the solution for you. I'm gonna outline this in this video. But you could ask me, why do you do this video right now? And the reason is simple, because this is the bull market. One, if you have not paid your taxes yet, now you will have the funds to cover even going back to the past 4 years. Because as Chris said,
it's not a question of if you will be caught, you will be caught. It's a question of when.
And in a second, I'll show you exactly how you'll be caught. Number two, by implementing the tips I'm giving you in this show, you will have a much better starting point and you will be able to optimize your taxes going forward. If the tax year ends, there is nothing you can do. So going forward, the only thing that you can do to optimize your taxes is to be proactive and know what you got to do. So let's jump into the show. Number one, how will they catch me?
Yeah, so this is a conversation we very often have with clients. I first want to find out, before I proceed with your services, let me make sure that I can be caught. Otherwise, it's a different discussion. Absolutely. Yeah. If we look at what's happening in the US, the IRS is becoming very aggressive. They've appointed 87,000 additional staff, and they said a part of that focus is crypto. End of February this year, they appointed 2 big crypto space tax advisors. One that was, which is interesting, the head of global tax for Consensus, and Consensus is of course the parent company of MetaMask, and then also another person that was head of global tax for crypto tax software. So they are bringing in a lot of experts. So absolutely, it is traceable, and here's why. Somewhere most people have a fiat on-ramp. So even if you only use a hot wallet, let's say MetaMask, you still have a Coinbase account or a Binance account where you put in your fiat and you have KYC and you move that to that hot wallet. That centralized exchange like Coinbase have your identity, and they have, of course, the transaction history of where you moved that crypto. The relevant institution you use, Robinhood or whatever, they send a form to the IRS to report your gains, losses, income, etc. They aren't giving that finer grained data straight up, but if the tax authority asks for it, which is happening now, most exchanges will not fight that. They will give it. Some exchanges might fight it and lose. in the court. And then they have your finer grain data and they can see all the possible wallet addresses you've moved crypto to, and they can put that wallet address in Etherscan and see other wallets that was transferred to, etc. And there's tracing software. I mean, the moment we get our clients' data and we put it into software like Chainalysis, it becomes very clear quickly the whole flow of that data from the centralized to the hot wallets. And let's remember, the blockchain is one, immutable, and 200% transparent. So all that is protecting you, if that is your argument, is that your name is not next to certain addresses. And that can be traced from an entry point from KYC exchanges. And then if the tax authority is unsure, they send you a letter, and this we've seen, and they ask you, is this your address or not? And of course, if you're at that point gonna say no, that's a different kind of situation.
It's all good and fine, but what if I use a non-KYC exchange, you might ask? Good question. So the thing is that exchanges, even the non-KYC ones, have a lot of information about you. We're talking about email address, we're talking about phone number, IP addresses, through that your location. If you're a small trader, maybe you have not much to worry about, but if you are becoming a larger trader or the platform that you're trading on gets a major investigation, you can get in serious trouble because they might be able to backtrack you from the information they already have. Of course, you can use a burner email and you can use a VPN and you can do all that, but you really have to evaluate whether it is worth doing that. Now that we agree that they are going to catch you, we can talk about what is a taxable event in crypto.
Pause there and say, what is a realization? A realization in crypto is if you sell your crypto for fiat, if you trade your crypto for other crypto, if you spend your crypto. So this is one a lot of people don't take into account. If you have a Binance card and you buy a coffee, you are actually selling your crypto for fiat. So those are all realizable events. In some cases, in some countries, it's even a realizable event if you put it into a liquidity pool.
So in general, you gotta pay taxes when you sell to fiat, when you swap from crypto to crypto, and when you spend your crypto through a crypto card. I'm actually planning a special video on how you can save a bunch of money using crypto cards. If you want that, let me know in the comment section. So let's look at everything separately. Number one, investing. If you're investing, meaning you don't swap and buy and sell and transfer and MetaMask and all that, but you buy the coin on an exchange, you leave it there, and at one point you are selling it, you only pay tax when you sell your crypto. If you sell your crypto over 12 months, that will consider as long-term holding, and that have a different capital gain bracket, meaning you will most probably pay less tax. Number two is trading. Trading is swapping or buying, selling different coins. So whether you're leverage trading, whether you're spot buying and selling, whether you're just swapping on Uniswap, whatever you do, that is taxable, every single transaction. So for example, if you buy Ethereum for $1,000 and you sell it for $2,000, you have to pay capital gain tax on the $1,000 profit. If you buy Ethereum for $1,000 and you sell it for $500, you will have a $500 loss that you will be able to use to offset your gains in the future. Same goes for swapping. If you have an Ethereum that you bought for $1,000 and you swap it to Solana when your Ethereum is worth $2,000, you have to pay tax on that $1,000 profit. And now the cost basis for the Solana that you have is $2,000. So just to make it understandable, if your Solana back, if you buy Ethereum for $1,000, you swap it to Solana when it's worth $2,000, you pay capital gain tax on the $1,000, and your Solana bag is worth $2,000. When your Solana bag goes to $3,000 and you sell it to fiat or swap, you will need to pay capital gain tax again on the $1,000. Number three, NFTs. So when you buy an NFT that has a price that you buy it for, that's basically the cost basis that you have. That means if you buy an NFT for $1,000, if you sell it for more than $1,000, you will need to pay capital gain tax. If you sell it for less, you can write off that amount. Now, if you've noticed, I'm talking about capital gain tax because you gain something from the purchases or from the transactions that you're making. That is a different tax than an income tax. So if you buy an asset, for example, crypto, and it appreciates in value, you have to pay something called capital gain tax. It's a different bracket, different percentage. But if you work or you get paid for your work, you have to pay something called an income tax, and that's also a different percentage. So why is this interesting? It's interesting because if you're getting paid in tokens, if you're getting airdrops, if you're getting staking rewards, if you're mining, you will also have to pay income tax. Now, if it doesn't make sense now, hold on here because this is important. This is the number one thing that can really wreck people in crypto. So let's say that you get paid in crypto. When you get paid in crypto in the native token of of the project, you have a cost basis, the value of those tokens on the day you receive them. Let's say I get 10 tokens for my work and one token costs $10. So I got $100 worth of tokens. On that $100 worth of tokens, I have to pay income tax no matter what. It doesn't matter if the coin price goes up or down, I will have to pay my income tax. If my income tax is 20%, I will have to pay $200 from the day I receive those tokens. So the problem comes in when I don't sell those tokens, but the token value fluctuates as the market goes. Let's assume that the token goes to zero, I still have my income tax that I have to pay. But because the token went to zero, I have nothing to pay it with. So even though I made no capital gains, I still have to pay my income tax. So always pay attention when you stake and you get rewards, when you mine, when you get airdrops, or when you get paid in crypto, you always have to understand your income tax bracket, understand what percent you have to pay of that amount, regardless of the token price appreciation or not, and withdraw that amount. Take that amount, sell it, and make sure that you have funds to cover the income tax that you will need to pay. Now the question might come, what happens if the project is a rug? So let's assume you get an airdrop, you wake up the next morning, and the airdrop when you got it was worth $1,000, but now it's worth $1. So with a 20% income tax, you would have to pay $200, but you don't have anything that you could have sold because you didn't even know it existed or you were asleep. Now technically you would have to pay that tax even though you had nothing to do with the airdrop, but more and more regulations are coming in different countries. For example, in Germany, if you did not have anything to do with the airdrop, you do not have to pay the income tax. So pay attention to that and check the regulations in your own country. But that's not all, because you still have the capital gain tax. So let's stick with the example that the coin that you receive is worth $1,000 when you receive it. Next morning you wake up, it's at $1. The income tax we talked about. What is the capital gain tax? Because the tokens that you received it at $1,000 and they went to $0 or $1, if you can realize that loss, you have $900 or $1,000 offset to your capital gain taxes. So if you can realize the loss, meaning you can sell the token, there is still liquidity, or if there is no liquidity, you can send it to a simple burn address. You can Google burn addresses and send the token there. Then you realize the loss and you can use that to offset your capital gains in the future. So if there is a project that rugged you and you lost $1,000 and you have a project that you made $1,000 on, you have to pay 0% capital gain tax. Again, remember, that has nothing to do with the income tax. I know it's heavy. I understand it's heavy, but we have to talk about this because it will come and bite us in the ass. So a little breather, I have good news because there are events that are non-taxable in crypto and we can take advantage of. Number one, long-term holdings. I talked about this, but if you hold your coins for more than 12 months, on most jurisdictions, you have lower or no capital gain tax. Number two, transfers. If you transfer between your wallets, whether it's centralized exchanges or decentralized exchanges, you do not have to pay tax on those transfers. Number three, gifts. If you receive crypto as gifts, there is no tax obligations on that. But if you give the gifts, that counts as spending, therefore you will have to pay the capital gain. Now, what if you got hacked or an exchange went bankrupt that you had, or you lost seed phrases to the wallet that you owned? Well, in that case, you cannot write it off as a loss, so you cannot offset your capital gains. However, you do not have to include that in your reporting. So if those coins are still there and you cannot sell them, you cannot realize the loss, therefore you cannot offset your loss. But again, you will be able to leave that out of your taxation and you don't have to pay taxes on those coins. Important to note though that there are jurisdictions that allow you to offset the cost basis, the purchase price of the crypto that you lost. So that's also pretty cool. So by now, probably all of you either turned off the video or just sitting like this thinking, what the did I do? So let's start figuring out how we can clear ourselves for the past years. Number one, very important, there are a lot of volunteer reporting opportunities right now because there is no regulation, because the tax agencies don't really know how to deal with this whole thing. They allow you to voluntarily report the taxes that you have not reported and they don't give you penalties. You will still need to pay the tax, however, you don't have to pay the interest and you don't have to pay the penalties. So check that out in your country. If you have that, use it. Second, you have to start sorting your data. Here's what Chris says.
The first thing is you now have to get all your data. And that means in most cases, have a list of all your hot wallets that you've used, just the public addresses. Get access to, let's say, CSV files from your centralized exchanges or API keys, read-only API keys. All that means is whichever software you're going to use now to calculate this and do your work on, you can enter API key and secret and draw that data directly from from the exchange. But the focus here is on complete data. If you have gaps in your data, so in calculating crypto taxes, there's one phrase that we use, and that's cost basis is king. You need to be able to prove your cost basis, and the more complete your data is, the better.
To organize your data, there are a lot of softwares you can use. Chris said they tried a bunch and Coinly worked the best. You can try Coinly. He says it's not as simple as they say, that you just plug it in and it works, but you can try that. In my personal opinion, the best thing is to use a company, and here's why.
Most of our clients attempt this themselves, and mostly they attempt this on Coinly, but they realize at some point that it's a lot more work than they thought, because you still have to do a lot of pre-processing on your data. You still have to manually intervene. You have to go, our reconciliation team after our data phase, they go through every transaction and make sure there isn't a transfer that's been missed. The moment you miss a transfer, so let's say you use Coinbase and you use MEXC in two totally different jurisdictions. So maybe the CSVs that you used, because one of them don't support APIs, is UTC +2 time zone. The other one is GMT 00. Now, those transfers might not be picked up by the software. So now it's taxable events, because if you cannot show it's a transfer, it's a taxable event, and you're not tracing that cost basis. So it's super important that you very carefully go through every transaction. Same thing when you're bridging. Many times bridges are not picked up because you have a different token coming in. Many times, even though the data is in software like that, we have to open up the relevant scanner and we have to look in depth what actually happened in the internal transactions to figure out what happened there.
Talking about bridges, today's sponsor is the most seamless Celestia bridge, Trestle. Celestia is the new shiny thing. If you watch this channel, you probably heard it a million times. It's kind of like a layer 1 blockchain that is adopting a completely new approach and therefore can be categorized as a modular blockchain. Now, modular blockchains and Celestia as well is completely new, and it's in a very early stages of development, but it aims to facilitate transactions much faster through specialized blockchains and therefore much more securely. But Celestia is kind of like a closed ecosystem. It's very difficult to get into Celestia ecosystem from different ecosystems. And here's where Trestle comes into the picture. So Trestle's mission is to allow seamless connection between Ethereum chain and Celestia chain. Through Trestle, users can expose themselves to Celestia on Ethereum chain using 𝗬𝗓𝗘𝗑 or 𝗬𝗓 and earn 𝗬𝗓𝗘 by holding Trestle. So with the help of Trestle, anybody from the Ethereum ecosystem will be able to get exposure to the Celestia ecosystem without having to bridge over to the Celestia network. If you're bullish on modular blockchains and if you're bullish on Celestia, you probably have to be bullish on the bridges as well. Now, as I said, modular blockchains are completely new and therefore not many people understand them. In a traditional blockchain world, you could call Trestle as a bridge. However, in the modular blockchain world, Trestle is not just a bridge, but it's much more than that. It's kind of like a layer 1 itself. If you scroll down on their site, you will see Trestle's 4 Celestia pillars. Number 1, manage 𝗬𝗓𝗘𝗑. 𝗬𝗓𝗘𝗑 will now be available for Ethereum users to purchase on Ethereum chain, allowing exposure to 𝗬𝗓𝗘 without having to bridge over to the Celestia network. This is what I explained. 𝗬𝗓𝗘 bridge, seamlessly and securely swap between 𝗬𝗓𝗘 and Ethereum. Earn 𝗬𝗓𝗘𝗑. You will be able to earn 𝗬𝗓𝗘𝗑 through staking Trestle. Obviously, when people use the bridge, there is a small fee, and that fee gets distributed to the stakers. And then Trestle chain, which is very, very interesting for me. Trestle will be releasing their own roll-up chain on Celestia. Trestle's incubator will onboard new teams onto the Celestia roll-up on chain. So it's not just a project, not just a bridge, but they will create an incubator to help builders go and build on the Celestia blockchain. They constantly announce their partnerships as well, most recent being Milky Way Zone, which is the biggest liquid staking protocol on Celestia, or Caldera, which is also a very prominent player in the modular blockchain space. They obviously have a token called Trestle, very, very early stage. Again, this is one of my degen plays. This is one of the zero or hero plays, in my opinion. If you're bullish on the tech of Celestia, which I think is fantastic, I'm just not sure if it's retail friendly enough to be huge this pool, but if it is, or if you want to invest in the long term, I think this can be very, very interesting. The good thing about the token as well is that you can stake it and gain yields. On their website, you can go to staking. What's also interesting is that they use staking length to determine the amount of coins that you are going to get as rewards. So the more committed you you are to the network, the more coins you get, and therefore the higher your ROI is. If you're interested in the project, I advise you to read your docs. They have everything very nicely outlined: the welcome, the mission, overview, bridging process, tokenomics and whatnot. They have an audit for the bridge as well, which is also super interesting. Very important, I do hold a tiny bag as a degen play for myself. There's only one thing I don't like, is that the team is not dogs. However, I still think the risk reward is there, and if they pull it off and if they become the main bridge on Celestia, this can be very lucrative.
What you will see on the software is that it also doesn't support a lot of things. Like many times there's issues like the Solana. A Solana recon is very manually intensive. Osmosis recon is very manually intensive, the whole Cosmos ecosystem. And it's just the way they structure their data. So then we have to use a bunch of scanners, use a bunch of our own software to figure out what's actually going on. So if you do it yourself, be prepared from the start to have patience and understand it's not going to be quick. If you're going to try and do this quickly, you are just going to get frustrated.
If you believe you have the mental fortitude to go through with this, here's how you should do it. If you have been mostly holding and not trading that much, meaning you had a trade here and there, you sold and bought, but that's not the main reason why you are in crypto, and you don't have a million MetaMask wallets and Phantom wallets and 5 exchanges and non-KYC exchanges, here's what you should do.
Just to touch on one other thing you said, let's say you only had Coinbase and Binance US. There's a good chance you can use the software, connect it, and it's going to be perfect. That is possible. And maybe you had one MetaMask wallet, EVM chain, only Ethereum, you just fix one or two things. So many times when your situation is very simple, it's not going to be a month job. But a lot of clients have spent 3 months on calculating the 5 years that's outstanding, because you also have to remember what you did in 2017, which is not that easy. So it is quite a manually intensive process. And then also you can use external analytical tools and scanners to help you build out the picture. But practical steps is get all your data, put it into the software, go through all transactions and make sure everything is correct. Pay attention to the warnings, and then once you are happy, you can generate your reports, and then that reports you need to discuss with a local accountant or tax advisor to go about correcting prior years.
But if you are a degen like us, I mean, we can't help it. First of all, you gotta subscribe. That's what you should do, because we bring you the best alpha. But you know this already. The first
step is get all your public addresses, get CSVs, get your API keys, then subscribe to something, whatever you think is the best reconciliation software. Put your wallets in, put your CSVs in, all the stuff that's not supported. Start making your own custom imports that you need to import then. And then you have to go through every single transaction and see what is the software actually doing with it. Seeing that if that market values are correct. If you're into meme coins, there's a world of hurt when you work with these software, because a lot of them are limited on 16-bit integers or 32-bit. And sometimes meme coins have an extremely low value and an extremely high quantity. So then market prices are not picked up correctly. So you have to make sure. Many times we have to intervene and fix market prices because the wrong contract address is used to determine the market price. So you have to also make sure your market prices are correct. So if you are into experimenting and using, a bunch of Phantom wallets on Solana, and you're also into Osmosis and Sui network and all that type of stuff, it can quickly become overwhelmingly complex, because firstly, you open up a wallet for everything you want to try, and you now have to find out what is all the wallets I've opened, what is all the exchange, all the blockchains that I've actually used, what did I do on this protocol? And then you start with yield farming and stuff, where you now have to remember, I took this, then I locked it up and I got an LP, but then I staked this LP and I got another type of token back. And then if you go to things like transaction volume, because you know how easily, if you sit and degen all day, you rack up 400, 500, 600 transactions in a day, because you do one thing, but you're hopping between liquidity pools to exchange something on a DEX, and now you get 15 transactions where it was actually one. So you rack up a lot of transactions quickly. So it can become extremely complex. Just to even, if you look at Solana, like Magic Eden and those stuff in the past, it's very difficult to reconcile. And I think, again, don't do a half job. If you're not willing to understand and go back and figure out what you've done, then don't do it yourself. Rather let somebody else do it. Again, I'm genuinely not trying to self-promote here, but teams like ours, they've been doing it for years and they're doing it all day. So they understand how Magic Eden worked in 2017. They understand the nuances with Cosmos. They understand the nuances with other things. So be willing to put in that work. It genuinely pays off in tax savings. And then also data volume. A lot of the software cannot handle volume above a certain number. It becomes too slow and the reconciliation becomes too painful. So if you use bots and you're sitting with 1 million transactions, then you have to again understand aggregation or bulking, that you can bulk some of those transactions together based on certain principles so that you can get your transaction volume palatable to take it into the software. But you can't bulk or aggregate if you don't understand what's the tax implication of doing that.
And since we're still talking about how we can clear ourselves for the past years, if you've been here long enough and you've been involved in the NFT mania, and if you bought a bunch of NFTs that went to zero, or you made some money on NFTs, here's what you should do.
And then we haven't really touched on NFTs. NFTs is, of course, a super important factor as well, because sometimes you do bundle purchases where you pay a certain amount and you get 10 NFTs, or you send out 4 ETH, you get 10 NFTs. Make sure the software that you're using know that 4 ETH needs to be split between those 10 NFTs, for example, and you don't sit with 9 NFTs without a cost basis. Sometimes you burn NFTs to get new NFTs. So that's kind of a mint burn transaction. Now you have to manually carry over the cost basis of the NFT you're burning to the NFT that you're minting. Otherwise, you're going to sell that NFT you minted for 10 ETH later, and you're going to have a zero cost basis, so you're going to pay tax on the full price.
And after all this, you still have to understand inventory methods and liquidity pool regulations. So what do I mean by that? So for example, if I bought Bitcoin in 2016 for $500 and I bought Bitcoin in 2023 for $20,000 and I want to sell them today at $70,000, which one am I selling? The one that I bought at $500 or the one that I bought for $20,000? Or in the case of liquidity pools, if I provide liquidity and I get LP tokens back, is that a taxable event? Well, let's see what Chris says.
When you've now figured out all of your data, you've reconciled every transaction, you must understand the relevant inventory methods that is allowed in your country. Back to our example, we're selling 1 Bitcoin that we purchased in 2018. Adjustment to the example is we purchased more Bitcoin every year and here and there, and we're selling our first Bitcoin now. Which Bitcoin am I selling? Is it my oldest one? Is it my most recent one? Is it my most expensive one, or is it an average of all my Bitcoin? Now, this is country specific, but if we use the US as an example, you can use first in, first out, last in, first out, highest in, first out, and average cost basis. So then that Bitcoin, if I use first in, first out, that Bitcoin comes from my oldest Bitcoin. So my holding period is longer, but my cost basis might be smaller. So my gain bigger. If I use last in, first out, I'm selling from my most recent purchased lot of Bitcoin. Highest in, first out, I'm selling my most expensive Bitcoin. So my gain is smallest, but maybe my holding period is also shorter. So now I'm into short-term tax, or I can use an average, and that is of course just an average of your crypto. And this differs on countries. Some countries make it simple, like Germany, you're only allowed to use first in, first out. UK only allows to use average cost with shared pooling. Canada, you're only allowed to use average cost. Australia, a bit more complicated. If you're seen as an investor, you can use first in, first out, last in, first out, highest in, first out. Or if you're seen as a trader, it has to be first in, first out. But you need to understand what your country allows so that you can play around and see what works, what gives me the most tax optimal situation for my data, and not be blinded by that. Also check, how does this influence your short-term gains versus long-term gains? Because in Germany, if you can go more to long-term, you don't pay tax. In the US, long-term, you pay a lot less tax, etc., etc. So you have to understand the inventory methods. Then you also have to understand your country's specific stance on things like liquidity pools, staking pools, etc. Because if you look at any gray area, when you, for example, enter a liquidity pool with USDC and ETH, and you get an LP token back, is that a taxable event or not? If you're going to be conservative, you're going to take that as a taxable event. If you're going to be more aggressive because it's gray in your country, you can argue it's not, because you still own that underlying pair. Now you want to make that a non-taxable swap, where you transfer the cost basis of that underlying pair to the LP. When you exit, do the same, so that you only realize that gain or loss when you actually trade that for crypto or fiat. And then if you have crypto in a rebasing protocol, you're going to see on the software, I'm now taking this out of my protocol, but that there is a missing cost basis because they say I'd never had that much crypto, because it doesn't account for the rebasing. So now you have to manually adjust that rebasing and handle that as income. And this is all good and well, but if you are a proper degen, or if you are an OG degen, you're sitting with a situation where you have to do this for 40,000 transactions since 2017. And I honestly think some people just give up and they're like, okay, I'll rather take jail time.
Now, if you're clear and you're done and you say you paid all your taxes, you're done, what do I do going forward so I don't get into this crazy mess? Number one, you gotta keep track of all the wallets and exchanges you use. Have an Excel sheet, put in the wallet addresses, put in the exchanges, put in everything that you need to be able to recover the information anytime. Number two, through that, keep track of all your transactions and holding periods. So prepare for the tax year. If you know that you have held something for more than 12 months, you might wanna consider selling it. If you know that you don't have these rules in your country, you might wanna consider selling earlier. Also, if you have a lot of loss on different positions, you might want to consider selling them, writing that off as capital gain and leveraging that on the coins that you have massive gains on. But of course, other than everything we talked about, there are additional tips that Chris is bringing us that can help us minimize or completely wipe off our taxes.
We need to talk about tax loss harvesting. So what this means is I'm in the current tax year, my ETH position is looking amazing. I'm planning to sell that, or I have sold it, and I made $100,000 gain on that. My XRP position is looking horrible, so I haven't sold that, but I'm sitting with an unrealized loss there of $100,000. So that means my inventory that I have of XRP, let's say I have 100 tokens, I paid for that $200,000 way back. It's now worth in the market 100,000, but I haven't sold it. I have sold my ETH and I sit with $100,000 gains. The moment the tax year tick over to the next tax year, there's nothing you can do about it. But what you can do now is sell that XRP so that you get that loss on your books. And that loss will now offset the gain that you made on your ETH. Only thing to keep in mind here, that's what we call in some countries wash trading. What you need to keep in mind is your country's specific rules. In the US at the moment, because crypto is not classified as a security, wash rules do not apply. So you can sell your XRP, immediately buy it back. That's your investment thesis to still have it. And you just put that loss on your book. You've only incurred a network fee, but you got that loss on your books. In some countries, it is a bit different. Like for example, in Australia, you cannot buy back that same asset within 30 days. Then that loss is not going to be counted. So if it's your XRP that you're selling, you have to wait 30 days before you buy it back. You can trade your XRP for something else, like Solana or whatever. In Germany, there's also currently not wash trading rules, so you can sell immediately, buy back. UK 30 days, South Africa 45 days, Canada 30 days. So that depends in your country. But this is the single thing that we've seen where people consistently wipe out their taxable gains legally. If they understand this, you can so easily create those losses on your books proactively. Same thing in the US or some other countries also. If you sit with a bunch of tokens that you paid $100,000 for, being rugged or whatever, you cannot even sell it, there's no liquidity. That's not a loss that you can deduct. You have to get rid of that token. You are allowed to send it to a burn address because now you cannot access it anymore, and that's a loss right there. If you're sitting with a bunch of NFTs that you know that project's dead, you know this thing will never rise up again, but you paid 5 ETH for it. There's websites where you can actually sell that NFT for almost no ETH just to get that loss on your books, or you can burn that as well. But by just doing this proactively, you're getting the losses on your books because you now understand gains and losses. So this makes a massive difference, kind of proactively tax loss harvesting. And then also, as I mentioned before, just being cognizant of your cost basis and your holding period. So when you make this trade, you are aware of what the tax implication of this will be, even if you just understand what it will be roughly. That also helps a lot.
And then the big question, what about Palau digital residency and stuff like that? Now, if you have not heard, there is an option where you can get a digital residency in, for example, Palau, and you can KYC to an exchange, therefore avoiding paying taxes. I thought this was a fantastic idea, but Chris thinks otherwise.
I think that is definitely has its risks, of course, because it's all good and well, but if the IRS says it's not good and well, then it's not good and well. So it depends your government. Many times you call that, you have two things. You have tax avoidance and tax evasion. Tax avoidance is legal, tax evasion is not legal. So many times what we hear tax authorities say is phrase substance over form. So you've set up this form that you are not a tax resident resident here. But they say substance is which roads do you use? Which public schools does your children go to? Which medical systems are you in? That is where you are paying tax. You are using these resources. So be careful, because with those things, we've seen people being so confident in these forms they've set up, and then 6 years later, they absolutely screwed. So be careful with those things. I think a lot of it kind of aligns with DAOs. Where are DAOs taxed? Because it's decentralized. A lot of views on that, but typically it always traces back to some source or person involved. That is where you're going to be taxed. So I would say it's much better to be compliant, not try and do anything fancy, but once you are compliant, be as aggressive as possible with tax optimization. That's ultimately part of your APY.
And then there was one last thing I really wanted to know, and that is, what comes next?
Regulations will take some time. They are very hesitant to bring out regulations while they don't understand crypto well enough, and then having to amend that regulation. So that's going to be most countries' last steps, giving official regulation, amending their tax act for crypto. That's going to be the last step. The first step we're seeing is enforcement, where they are partnering with private companies. They are pointing people from the crypto industry to understand better, and now they're going to enforce. And that's what we're seeing with the IRS court cases, with court cases in other countries. They're saying, give us this data. We want to understand, because they know there's a lot of unpaid taxes there. So enforcement is one thing we're going to see over the next 2 to 5 years a lot. We are going to start seeing movement on tax acts being amended, like we are starting to see in some countries now. We are also going to see a kind of an upskilling of the staff of tax authorities so that they understand that better. And then, of course, the other thing is the relationship with centralized exchanges, and the government is changing all the while. South Africa is now, before the end of this month, they are actually approving 60 centralized exchanges under the normal financial regulations here, and that changes the relationship with tax authorities as well. So we will see a lot of guidance coming out, not amendment of tax acts yet. Some countries we are, but not a lot. But enforcement. I think enforcement is definitely the next phase.
I know, but we are at the end. I'm sorry, don't shoot the messenger, shoot the message. I know it's been tough. I know it's been long. I know it's been difficult to digest, but I think we needed to talk about it. If you have watched this video through the end, I salute you. Thank you so much for watching. If you got any value out of it, please smash the like button. Let me know in the comment section if you learned something. Follow me on Twitter. I bring you money making tips every single day. Check out the thread I wrote on taxation on my Twitter page, which summarizes everything that we've talked about. If you're there, smash the follow, you won't regret it. And most importantly, pay your taxes. For real, for real. Thanks for watching. I'll see you in the next one.